All right, everybody, it's that time of the week. It's Friday, so this is Middle Class Investor, and it's Friday the 21st of July. We had another up week, another big week in the market. You can see right here, the market closed above the previous week's high, which is still bullish, and I don't know what you say about it. We had a little consolidation here. Got this little run up here for the last 2 weeks. If it turns out to be kind of like this one, we have this consolidation. We got several weeks of uptime. It's really getting long in the tooth, but I've been saying that for a while, and so I'm not so sure how much higher it could go. There is a lot of complacency in the market, and that's usually not a good sign for the bulls. But the bottom line is we've got to see some weakness before we can say that it's going to do this. It's going to pull back to here. Just to kind of give you an idea on the VIX. The VIX was sorry, I'm having trouble. I always have trouble finding the VIX in my list here. Something about there it is. Something about the way they list it. It's not under V, it's under CBOE. So I always forget that. Anyway, this level here on the VIX. Well, let's put it this way. We haven't seen this low level, this low close on the VIX since like 1994 or something like that, 1993. It's been a long time, long time. So a lot of complacency in the market. I suppose it could go, go a little lower. But these low levels of the VIX are very, very scary because, let's just go back. Let's go back to 2007 real quick, and let's just remember something here. And I'm going to use a little term. Let's get off of this. Go back to the S&P 500. But right in here, if we zoom in here, there's a saying that the market takes the stairs up and the elevator down. And you can see these are weekly bars. And so from, just in 1, 2, 3, 4, 5, 6, 7 weeks, we had a drop of 250 points. If you go a little further, then we had a recovery of, 50 points. You go a little further, and then you had a drop of 1425 down to 1200 again, another 250 points. And then we had this big drop that went from 1300 all the way down to 800. So the elevator down is very, very rapid, and I'm going to go out a little further just so we can get a better perspective on what happened here in 2008. So see this slow move up? It's the stairs up that took, from 2003 to 2000, almost 2008. So it took 5 years to go from 800 to almost 1600, and then it took from late 2007 down to early 2009, so a year and a half to traverse the same distance plus some. So that's the kind of damage you can have in your account. You got to be really careful. So yes, the market's still going up, and yes, if you're in, you're making money, but I can't caution you enough about that. So one of the things I have up here is a Sorry about that. This dog's barking. I've got a little study up here that's kind of a good long-term little study. It's called a 4% study or something like that. And if I zoom in here, we can kind of see how it works. So these lines, something about the way the bars, 4% difference between the bars or something that causes this study to turn. So if you were looking right here, let's say, this would be a buy signal. Now, what we could do is we could use this study on the sell area. So next week, let's shorten this a little bit. Let's just take that off. So next week, if I get if this blue line starts to do one of these, then maybe we take that as a sell signal. So in other words, a bar, you would have a bar, something like that, and it would cause this thing, this line to move from this angle to this down angle. So I think that's a good, non-arbitrary way to kind of signal us out of the market here. Now I still think we're going to get another down up sequence, and the reason I think that is because, well, let's just draw it on here. Most of you know that I watch these Elliott waves, and the reality is we've got a wave 1 here. This is a wave 2, and all this appears to be wave 3. Well, if all that's wave 3, then we're going to have a 4. Right, we'll have a 4 comes after 3, and then a 5. So we could be looking at, almost 2,600 on this index before the fractal, the nested degrees of trend top. And I think last time I counted this move, and I'll show you something in a second. I want to say it's like 5 degrees of trend or 4 degrees of trend. So we're talking about, potentially a very large move down, major damage to your 401k. So I want to keep an eye out for that. We want to make sure we are not on the train tracks when that train comes barreling down. All right, let's look at interest rates. Short-term interest rate continues to see. Here's an example. Now this isn't a great example because it kind of whipsawed in and out. I mean, out and in, so down and then right back up. But having said that, you would not use this system on this short-term interest rate index. Anyway, the point right now to look at this chart is that short-term rates are still going up, although talking heads are talking about the Fed's not going to raise any more rates, or they might raise one more time this year, and so on and so forth. I guarantee you the Federal Reserve is looking at this and they're saying, oh my gosh, we've got to raise rates. Now last week we had this kind of hangman here, and I was thinking we might get a little pullback maybe to there, and then but man, it just took off for another run up. So this looks like it's getting toward the end, because when you start to see this kind of down up right here that we see right here, when we start to see this almost looks like some sort of a triangle or a consolidation here. And when you start seeing stuff like that in the chart, kind of like these right here, you're getting close to the end of a particular trend. Now this one extended on up, but usually you don't get multiple extensions. You get 1 or 2, and that's it. So anyway, that's short-term rates. The 10-year and the 30-year actually pulled back this week. You can see that here, and they're different markets, so they're gonna act differently. Now, it's unclear to me whether or not this is going to, continue to pull back to just below these lows here, or if it we can keep an eye on this little blue line, this 4% model. If next week it starts to curl up, then we can pretty much say that the low is in on the interest rates, i.e. the high, the counter trend high on the bond market is in, and this could actually cause the market to really sell off if these yields really spike up over the next several weeks. It could cause a pretty dramatic sell-off in the market. So let's keep an eye out for that. We did close the gap, so that's as expected, and just waiting for the next move up here. So we're either going to move down here and then move up, or just move up right from here. So we'll see. We'll keep an eye on that and see what happens. All right. Let's look at these foreign markets. Germany. Germany continues to look like it wants to grind higher into this resistance area. We're getting a little bit of divergence here on the MACD. You can see the MACD is kind of curling down, even though the market's making new highs. So we'll have to watch that carefully. But I think the odds are good that, even if it pulls back to here, it's going to rally probably into this resistance zone. So keep an eye on that. You can see here, this one looks a little bit more tired. Not much. It looks like this could be like a little whipsaw. You can kind of see this pullback channel here. And now it's broken out of the channel, even though this line came down. So this looks a little bit bullish. I would say at least makes a new high, and it could actually break through this resistance area and go higher. Japan, there's a lot of quantitative easing going on in Japan. They're just destroying the Japanese yen. So anytime you devalue the yen, if you take a number and you divide a number, if you divide it with a smaller number, that makes the result go up. So that's what's happening in this Japanese market, is they're destroying the yen, and as a result, their market goes up. But the purchasing power of the people goes down. So the people can't buy as much, even though the equities are going up. People that live there can't buy as much with the yen as they used to be able to buy with the yen. And we're going to talk more about that in a second too. I got an interesting chart to show you about the U.S. and how that's happening in the U.S. So the United Kingdom, it's either lagging all these other markets, including our own, or it's in some sort of bear market rally here, and it should roll over soon. Now, what could happen is this could just be an ABC. So let me go back a little further. Let me go to 10 years. Yeah, this actually could be, because this did make a new, it made a new high right here, a slight high. Let's go back even a little further. Yeah, this could be like an A, B, and then we C, but we're in an ABC. So the United Kingdom could be revisiting these 2009 lows, but then it looks like it's going to be pretty bullish after that. So kind of looks like the currency itself. We'll get to that in a second as well. All right. I guess that's it for this section. Let's switch over to the toss charts and look at some of those markets. Let's look at the euro first. The euro is really strong this week, which means the dollar is really weak. And you can see we're at that resistance area. Now we could actually get a little pullback, and then another high with a new resistance area slightly above this one. But the yen, and the only reason I say that is because even though we're higher than this high, well, we're not quite higher than this high here. So to me, it's gotten this far. It's probably this box really should be drawn off of the. I'll show you off of the off of this pivot right here. So that really should, this box should be a little higher probably. So slightly above that box there. Do you see that? I'm drawing it off of this pivot here. So let me just draw that real quick so you can see which one I'm focused on. So there's a pivot right here, and that's the pivot. That's the pivot I'm drawing this box off of, which makes a lot of sense because, and I don't know why I didn't see this earlier. Sometimes you get kind of zoned in on what you're seeing, and you're not seeing something that's right there on the chart. But the thing about these pivots, so let's look at, there's a high here, but it's not higher than this high, right? And this high is not higher than this high. So the last run up into the high was right here. So it would make sense that if it's going to revisit, it's going to revisit off of this pivot high, not these others. Now it might slow down here like it did right here. It slowed down right here. And again, maybe it's going to slow down right here. But probably it's going to go to this pivot high. And I don't know why I didn't see that before, but sometimes the markets are like that. You get tunnel vision on something and you miss something else. So I mean, we're only human, right? So we can only see what we see. And that's, I used to have an instructor who used to say that. You can only trade what you see. You can't really trade what other people see. You have to learn to look at the patterns yourself and then trade or invest in what you see. All right, let's look at oil real quick. Oil's been bearish and it's been bullish, and it's just been choppy is really what it's been. So oil to me looks like these moving averages are rolling over, the longer term moving average is rolling over. Looks like to me oil wants to roll down, probably to visit this pivot. Here, I'll zoom out here so we can see the slightly bigger picture. So what was the most, so we're about even with this pivot. So the pivot into the low is right here, right? So let's draw that on there again so we know what we're focused on. So this last pivot into the low was right here. And you can see that I have the box drawn correctly on this one off of this pivot low. So my guess is, we're probably going to see oil come into this area, maybe rally, a little bit. We're probably in some sort of consolidation, some sort of triangle, and then maybe come down, into this area so that we got a little bit of a triangle being drawn here, and then so on and so forth. It'll continue to do that. Now, this part of the triangle is taking a long time, right? But that's because it's the very first leg of the triangle. Those are always the longest. As the triangle narrows, the up-down sequences get shorter and shorter, which makes sense if you think about it. Anyway, so I would look for oil to come down here first. If you wanted to get bullish for a trade, or maybe sell some puts or something like that on some oil stocks, you probably make some money right in here. But I would be watching it very closely, because then oil is likely to roll over and make a new low, which is going to pull down the oil stocks. Oil in general, oil stocks have really underperformed the overall market this year. And I think as long as you're seeing that, as long as you're seeing an underperformance in oil, probably just should stay clear of oil stocks. That would be my advice if I was giving advice, which I'm not. So I was going to see if I had the US. Yeah, here's the US dollar JPY. We don't normally look at that, but you can see the US dollar relative to the JPY is really strong, because the JPY part of it is getting weaker. Now, in this case, the dollar's getting weaker too. The dollar's been getting weaker during all this time here, and the dollar was getting really strong here. So it's almost, it's interesting about the JPY is it's really, it looks to me like it's somewhat correlated to the dollar. more so than some of the other currencies. So I don't generally trade this one. I stick with the euro and the British pound. But speaking of British pound, why don't we look at it right now? Here's the British pound, US dollar, and we've identified this rather large kind of ABC here, and the market's still bullish off of that. I gotta believe we're going to get some sort of pullback, and it could be a pullback that retraces quite a bit of this, because I'm starting to see a little bit of a what we call a rising wedge, and I've talked about those in here before. Where you get this consolidation that kind of narrows. So you get, let me draw it like this. You get this kind of narrowing consolidation, and when you get that and it breaks out of it, so once it breaks down out of this, you're probably going to get something to at least here, and maybe even slightly lower than that, maybe even to here. And that, I think, is going to be a great. Now it's going to be, there's going to be all kinds of talk about, the British pound's going to make a new low. I mean, and it could, but I think this is a great place to enter if we can get back down into here. And if you recall, the way we talked about trading that was in the FXB. So if you actually want to trade the British pound long, you would look at the FXB. And you can see here we have a sell signal on this 4% model right here. So right there. So we got to turn down. Now it could turn right back up next week, but a lot of times once these roll over, the way, again, if you're really into technical analysis and candlesticks and things like that, what you would see is, what you would look for is if we got a close next week that looked like that, well, then this is probably going to this pivot area right down through here. Okay. Again, great buying location if we can get there. Okay. It's probably going to go just beyond this. So that's why I have that trend line there, is if we can get back down to that trend line around 122, man, this is going to be a great buy, and it'll probably stall out right around here around 131, pull back a little bit, and then go higher again. So anyway, just keep an eye on the FXB. Whoops, that's not what I wanted to do. That's not what I wanted to do either. Tell you what, I'm just clicking on all the wrong things tonight. Okay, so what else were we going to look at? Let's look at gold and silver. We talked a little bit last week about how gold and silver were doing different things, but silver's bouncing nice and strong right here. It's good entry. Where's it likely to go? Well, let's draw it so we can have a target. Here's the last swing into the high right here off of this point right here. So let's put our pivot, our resistance area here, and we're expecting this to move. Sorry about all this clicking. Expecting this to move right up into this area here, around $18.50, $19. Okay. And if you got long back here around 16, I mean, this is going to be a good little trade for you. Or if you bought physical silver, also a good trade. Excuse me. Now gold, as you can see, gold didn't pull back as far. I mean, you got more of a. This looks like more like a wave 1 with an A, B, C pullback, and now we're in a wave 3. And so if this is a wave 3, we're talking about a pretty good sized move here. Another good way to do this is using Fibonacci. So if you go to the high and you pull back to the low, a good place to look is around 200%. So gold 200% of this pullback. So once gold breaks out above these highs, the target is about 200%. So that puts us at about 1396, 97, and that's pretty good. Be a pretty good little trade if you're trading the GLD. That's how you trade gold. That's one way to do it. Now I've got this box up here, maybe a little too high, maybe not. This might be the final destination. You know, in other words, wave 3 might stop right in here around 200%, pull back a little bit, and then make its way up in here about 1450. So we'll leave this box where it is just because that's where we drew it, and I'll leave this Fibonacci stuff on the chart so we can look at it next time. All right, I want to diverge, and I'm not diverging politically here, although some people might think, you know, discussion about the Fed, money and credit and all that stuff is political, but I do want to show some interesting charts. And I apologize, my NinjaTrader is down. I was moving some stuff around. I'm going to have to reinstall it, so I can't show you this, but I do want to show you how often you see this 1, 2, 3, 4, 5 stuff happen and the ABC stuff happen. But what you're looking at here is a chart that goes back to the 1970 pullback into what's called the cycle wave 4. And then we had this run up that's lasted all this time. You know, here's that 1987 crash, and here's the dot-com crash, and here's the run up into the financial crisis crash. But what's interesting about this chart is we're approaching 5 waves. And once you have 5 waves in any market, and I don't know, just this happens over and over again. You can see it here in this one with this smaller wave 1, 2, 3, 4, 5. You can see this ABC pullback. So that went from, you know, the Dow was what is that? Little over 8,000. Oh, this is by the way, this particular chart is divided by the SCB, which is a currency basket that includes U.S. dollars, Swiss francs, New Zealand dollars, and Asian, Japanese, kind of a mixture of Japanese yen, yuan, and stuff like that. And the reason they did that is they're trying to the waves. Well, let me just show you. The waves are kind of distorted because of the devaluation of the dollar. So if you look at this one right here, see how the wave B is higher than the wave 3? Well, that's because, you know, some of the value of the dollar has been inflated away during that time, and so the wave B actually is higher than the wave than it should be. It should be below 5, but it's not. So that's why they do this stuff. Or they divide by gold, but this one's divided by what they call the SCB. So anyway, once you have 5 waves, you get some sort of pullback, just like this pullback here, and we're going to get some pullback as well. So there's a clear 5 waves developing here. Here's 1, 2, 3, 4, 5. Now this low here is back in like 2006 or something like that, 2004, something like that. So it's slightly different, but it's a good way to look at the market. Now, another way they looked at it, which is interesting, is divided by the total amount of credit created. So the Fed, what the Fed does is it creates credit, and this chart here shows the annual creation of what they call M2 plus credit. So M2 is like your checking account and CDs and basically the money in the bank, okay, cash and the money in the banks. And then credit is that's what the banks create, right? So they create credit, and you can see since the creation of the Fed, we've done nothing but create more and more credit. And what this does over time is it devalues the dollar. Now, the interesting thing about this, and some of you may not know, but since the creation of the Fed, the dollar has lost roughly 98% of its purchasing power. 98%. Which now some of you will say, well, that can't be accurate because we can buy so much more today. We have iPhones and we have all this stuff. Well, so you've got two things going on. You've got the destruction of the money, and then you've got the productivity of the people. And the productivity of the people, in some regards, has outstripped or has outpaced the devaluation of the dollar. But not in all areas. I mean, if you looked at food, for example, bread and things like that. I mean, a loaf of bread used to cost a nickel or something like that. Well, now it costs almost $3. So, but it is true that we've been able to keep our standard of living up, but that's only been because of the ingenuity of the people and technology advancements and computers and things like that. I mean, if we didn't have this devaluation of the dollar, we'd be, I don't know, 2, 3, 4, 5 times richer than we actually are right now. But this devaluation of the dollar, it keeps us from really realizing our full potential, and it redirects some of that productivity back to the government and steals from us. But it's very, very subtle, and most people don't realize it. Now, when you take the Dow and you divide by this chart over here, when you divide these values by the Dow Jones Industrial Average, what's interesting here is the Dow actually topped in 1928. So we've never, in other words, this was the maximum amount of productivity we had as a country. So another way to look at this is think of this as productivity. So our maximum amount of productivity was in 1928, and we've done nothing but lose productivity ever since. Even today, that February 2000 low, we're as a nation, we're not as productive even as we were in 1999, or in 1959. And this kind of makes sense when you think about some of the people that are struggling in America, and this gap between the rich and the poor, and blah blah blah, all this stuff. It's all created by this money system, and you can see that we're starting to curl over, and there's going to be another leg down, and it's probably going to take us down below the 1982, whatever the 1982 value between the Dow and this M2 plus credit. In terms of our standard of living, we're probably going below that. So I just thought these were interesting charts. I mean, you can't find these anywhere. That's what I love about this Elliott Wave company, is they analyze the market from such a different perspective. Let me just show you what the Dow Jones Industrial Average looks like right now. So this is the Dow Jones Industrial Average since 1929 low. And you can see here, here's a large degree wave 1. I think this is what they call super cycle. And if you can see here, this sell-off into 1929 was of the same degree as this right here. So this wave A, B, C, D, E, this wave 4 here, see how it matches with this wave 5 here. So the ABC after this is 1 degree of trend higher than this parentheses wave 5 here. So if you think about it like this, here's the I was trying to understand the next degree down. So here's a good example. Here's 1 into 2 right here. So here's your 1, 2, 3, 4, 5, and then look how far 2 pulled back. It went from, say, 300 down to 100. So the idea is once this is complete, once this wave 5 here is complete, then the next degree wave 5 will be complete, and the higher degree wave 5 will be complete. So that's 3 degrees of trend. And of course, starting the next degree of trend will be 4 degrees of trend. So we're looking at a move that could take us back down to here, say below 2,000 on the Dow. Now I know that sounds crazy, How can that be? Blah, blah, blah. Well, the reality is it can happen. And I'm not saying it's going to happen. I'm just saying it can happen. And you definitely don't want to be in the market if it does. So let's see if we can find another chart. This is the run up from 1982. So another 5 waves up from 1982. You can see here's 1, here's 2. So in other words, the 1987 crash was a wave 2. See, it pulled back to the previous wave 4. And then you have 3. See where A pulled back to the previous wave 4. And see where the C pulled back to just below the previous wave 4 and the previous wave A. So where's the previous wave 4? Right here. This is the wave 4 below this high. So if we pull back from here, we could pull back to just below this 5,000 area and potentially even lower. So anyway, I'm not going to beat that to death. I'm just trying to point out the significance of where we are in time. You know, even as significant as this was right here, it's not as significant as what happens after this series of moves right here. This, even though this was bad and traumatic for the country, this is at least twice as bad, if not more, than this move right here. And it only has to do with, the reason it has to, it's at least twice as bad is because it's a higher degree of trend. This degree of trend here was a parentheses degree of trend. So it's not unlike what we're in right now. But this large Roman numeral 5 here, this is a large, I mean, it's not even on this chart. Well, it's down here. The 4 is down here. So this 4 corresponds to this 5. So, you know, you could have a situation where your first move, the very first move, before we really go up in a significant way, could be to here. Then we get a bear market rally, maybe up into this area, and then we have another leg down, which takes us maybe down to the wave 2 low from 1987. So it's just or maybe even here, maybe to 2,500. I just can't stress enough how dangerous this is for your money and really even for just your well-being in general. I mean, you really need to people need to really, you know, try to start saving cash, buy gold, buy silver. I mean, you really need to try to protect yourself from this. Another thing that I've talked about and I've done, and you don't have to do it, but I've done it. I've taken my personal money out of banks. Banks and credit unions operate slightly differently, and there's been a lot of changes to Dodd-Frank that basically, when you put your money in the bank, this is the simplest way I know to tell you. When you put your money in the bank, you transfer title of your money to the bank. The bank now technically owns your money. It's their money, not your money. Now you get a receipt in the form of an account that says you have claim to it, but the bank, the nature of the bank is to survive. So if what it means to survive is to take some of your money and transfer it to the bank's balance sheet, that's perfectly legal. I know it doesn't sound like it can be, but under Dodd-Frank and under some of these rules they've been passing in the Financial Services Committee, that is legal for the bank to do that. So you just really need to find yourself a good credit union, in my opinion. Again, according to me, as my friend Nick says, according to me, if you don't want to do that, don't do it. That's fine. I'm sure this sounds somewhat crazy to you, but the bank and the credit union, even though they both are federally insured, the FDIC is broke and the NCUA is not. So the NCUA is who insures your deposits at credit unions. And credit unions aren't involved in all this crazy, um, you know, mortgage-backed securities, and they don't buy government bonds. I mean, your credit union is basically operating like a traditional bank. It's loaning money to people in the community and charging interest. That's how it makes money. Whereas your what's called money center banks, they're doing all kinds of crazy things. They're highly leveraged in government debt, not just from our government, but from other governments, and they're much more risky. And you really ought to consider maybe doing some research and consider taking your money out of the banks and putting them in a credit union. But that's up to you. That's your decision. Just telling you what I'm doing. All right. That's it. Hopefully that's not too crazy and scary for anybody. I'll leave you with, I'll tell you what, why don't I leave you with the silver chart, which looks really good right now. And, if you're trying to figure out how to, you can buy physical silver here. And I know Schiff Gold was selling silver. They had a pretty good deal here recently. I don't know if they still have it or not, but if you want to buy, if you want to just trade silver, like you want to just own it and own paper silver, you could look at the SLV. That's silver shares. It's like the GLD, and you can see you got kind of an A, B, C here. So this is a good area to enter, and I would say, like I said, 1850, maybe on the SLV a little lower, maybe just below 1800. You need to take some profits. But if we start really having a crisis in America, a financial crisis, owning the SLV is not going to protect you. You're going to need to actually have the physical metal, the coins, the bullion. Coins is what I recommend, actually, because people recognize coins. They can see what it is and go, oh yeah, okay, that's worth, they know how much. You can look up online how much silver's in it or how much gold is in it, that kind of stuff. All right, everybody, that is it for this evening. I hope you enjoyed that. I hope if you got any comments, certainly I would like to hear them. If you think I'm just crazy and you want to say, hey, you're crazy, dude, that's fine too. Comment on that. Love to hear about it. All right, take care, everybody, and have a great weekend. We'll see you next time.